Hi everyone, welcome back to Corporate Decoder, where we break down confusing financial reports and find the real story. Now today we're diving into DMY Technology Group's latest earnings report. And let me tell you, there are a few things here that really stand out, especially when we talk about their cash position and how they're managing potential future redemptions and all that important shareholder stuff. Alright, so this is a quarterly report for DMY Technology Group Inc. It's essentially a check-in on how the company is doing financially during the first part of 2025. Now remember, DMY is a blank check company, meaning it's set up to go find another company to merge with. So it doesn't have a core operating business yet. Its main goal is to find that perfect match for a business combination. Let's start with a quick look at who owns what. As of late August 2025, there were about 23 million Class A shares and over 1.5 million Class B shares out there. Now let's jump into the heart of it, the balance sheet. This tells us what the company owns and what it owes at a specific point in time. Okay, so here's a critical number. The company has over $26 million in their trust account. This is the money originally raised from the public offering that's set aside to hopefully fund a business combination. It's pretty much their war chest. Now, this number here, derivative warrant liabilities, is a bit of a tricky one. It's over $11.5 million as of June 2025, a big jump from the $1.4 million in December 2024. This reflects the changing value of warrants the company issued, essentially as the market sees more potential for the company to succeed or for the underlying business combination to happen. Warrants can become more valuable and this liability goes up. And then we have this accumulated deficit. It's a pretty big negative number, over $19 million. This just shows that the company has spent more money than it has brought in since it started, which is normal for a company like this that's still searching for a business to combine with. Next up, the statements of operations. This is where we see the company's financial performance over a period. Here's that warrant liability again. For the first 6 months of 2025, the company shows a change in fair value of these liabilities of almost $10.1 million. This is a huge negative swing compared to zero in the same period last year. It really shows how much the market's perception of these warrants has changed, and it directly impacts their reported losses. And because of that big change in warrant values, among other things, the company reported a net loss of nearly $10.9 million for the first 6 months of 2025. That's a massive increase from a loss of just under $500,000 in the same period in 2024. You can see the different classes of shares and how many are outstanding. The number of Class A shares used for calculating earnings per share stayed pretty consistent. And that brings us to net loss per share. For the 6-month period, it's a negative $2.79 per share. That's a huge drop from just $0.12 per share in the prior year. This statement really breaks down the changes in the company's equity over time. This is a new one on the books, almost $422,000 in excise tax payable. This is related to those stock redemptions we mentioned earlier and a newer tax rule that's worth paying attention to. It's also a direct hit to their accumulated deficit. So now let's talk about cash, how the money is actually moving in and out of the business. For the first 6 months of 2025, the company used over $773,000 in cash just to run its operations. Pretty standard for a company waiting for a deal. But look at this, they deposited another $300,000 into the trust account for an extension. This is key. They keep needing to put more money in there to give themselves more time to find that business combination. And their investing activities show they used over $560,000. This is largely because of those trust account deposits. They are actively managing the trust account, but it's costing them. On the financing side, they received over $1 million in cash from related parties. This includes advances and convertible notes, which is how they're funding a lot of their operations and extensions. Overall, their cash position decreased by about $309,000 during the first 6 months of 2025. And they ended with just $348 in cash. That number is alarmingly low. It really highlights how much they rely on those related party advances to stay afloat. Now, digging into the notes is where we get the important background. It tells us DMY is a blank check company formed to find a business. They haven't started operations yet and are just focused on finding that business combination. This part is interesting. They moved their trust account money out of investments into a bank account in March 2025. The reason given is to avoid being seen as an unregistered investment company. This is a strategic move to ensure they stay within regulatory boundaries while they search. They were initially given 15 months to find a business to combine with, which ended back in January 2024. To get more time, they had a special meeting in January 2024 where shareholders approved extending this deadline. This is when they also saw a significant number of shares redeemed, about 3.9 million of them, which cost the company around $42 million. And it looks like they've extended that deadline again since June 30th, borrowing another $50,000, pushing the total under that convertible note to nearly $1 million. This note is crucial because it explains how they value those derivative warrant liabilities. They use complex models, and the inputs for these models like stock price volatility and risk-free rates are disclosed here. For instance, as of June 2025, the hypothetical stock price used in their calculations was $13, a pretty significant increase from $10, a pretty since in late 2024. And volatility is up from 3.3% to 3.5%. These numbers directly influence the change in fair value of those warrant liabilities that we saw earlier in the income statement. The change in the fair value of the level 3 liabilities for those private warrants shows an increase of over $2.7 million in the most recent quarter alone, bringing the total value to over $5.5 million, showing how much these unobservable inputs are impacting their financials. This section is about their internal financial controls. They've admitted to a material weakness in their internal financial controls. This was first mentioned last year and basically means there's a significant chance of errors in their financial reporting not being caught. And now they've identified a second material weakness related to how they handle excise taxes. This led to them having to restate some of their previous financial reports for the quarter ending March 2025. This is where they lay out all the things that could go wrong. They reiterate that those internal control weaknesses are a big risk. This could mean inaccurate financial reporting, and that can really shake investor confidence. They also highlight the risks from changing global trade policies and tariffs. This could make it harder or more expensive to find a business to merge with, or even impact the business they eventually combine with. So what's the story here? MySquared Technology Group is burning through cash as expected while hunting for a business to merge with. The big headline is that massive swing in warrant liability value, which dramatically increased their net loss for the period. They are relying heavily on advances from related parties as their own cash dwindles. And they're also dealing with a couple of key internal control weaknesses that could impact trust in their financial reporting. The extensions they're getting for their business combination deadline also mean they're continuing to spend money just to buy more time. Overall, MySquared is in a very typical SPAC situation right now, actively searching but facing the real financial pressures that come with it. The significant increase in warrant liability and the material weaknesses in their controls are definitely points to watch closely. It all boils down to whether they can find and close a business combination deal before their extended deadline and before those cash sources dry up, or become too risky to rely on. Alright, that's our deep dive into MySquared Technology Group's latest numbers. What do you think about their financial health and their prospects for finding a business combination? Let us know your thoughts in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate breakdowns, and don't forget to join our Discord community for even more in-depth discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.